Hi everybody, welcome to the Attract Capital webinar series. My name is Janine. I'm here with David Barnett, CEO.
Hi everybody.
Today we'll be talking about mezzanine debt pricing and explaining that. So Dave, what is general pricing of mezzanine debt?
Very good question, Janine. The general pricing level for mezzanine debt is in the 12 to 15% range for independent middle market deals. It goes lower or higher depending upon the size and the risk of the deal. And most of the price that you pay is contractual, meaning it's an interest rate, whether you pay that interest rate in cash or if you pay that interest rate in a fixed rate. And that's an important point to note.
Okay, and what are the ways that mezzanine lenders get this return?
Well, fixed cash interest of 10 to 11%, then payment in kind interest of approximately 2%, which is also known as PIK interest. And then they usually ask Janine for either an equity co-invest or a small warrant to get them from 12 to 13% up to the 15% range. There's also an upfront fee of usually a point to a point and a half. So you can generally pay around 11 to 12% on a cash basis and 2% on a deferred PIK basis, and then a little bit of an equity upside.
And is it possible to lower the cash interest rate?
Everybody wants to know that. Everybody says, I don't want to pay that 11 or 12% in cash. Mezzanine funds are not like banks in that they don't have the same cost of funds. And so they can usually get down to no lower than a 10% cash interest rate. It's hard for them to get down to 9 or 8%. We try to get them down that low, but they just can't generate the returns that they need to generate in order to keep their investors happy. So I would say 10% is the low end of the cash interest rate that they can do.
Good to know. And then are the other elements of the return flexible?
The other elements of the return are indeed flexible. They're a bit interchangeable. You can pay more in a payment in kind and have a smaller equity co-invest or a smaller warrant. You can pay more in a warrant and have a smaller payment in kind interest rate. You can even, if they issue a term sheet that says 12%, you can go to them and say, I only want to pay 10%, but I'll pay you a larger PIK. Usually they're pretty relaxed about how the components of getting their return as long as they get to that number in the end.
That makes sense. So then how does mezzanine debt pricing compare to private equity return requirements?
So, and that's one of the huge wins of mezzanine debt is that it's significantly less expensive than private equity. Private equity is about a 20% internal rate of return per annum. Mezzanine debt is only about 14 to 15%, so it's about 25% less expensive. And if you structure it the right way, it'll do most of the things that a private equity investment will do for you. So it's something that we believe it can have a significant, very large impact on your corporate growth if you structure it the right way, because it'll leave you with the majority of your shares in the company as opposed to being diluted by a private equity investor.
Well, mezzanine debt explained. There's your guy. And that's all we have for today. Thank you for tuning in, and we will be back soon.
Take care.